Well, perhaps the most important piece of data we'll be getting throughout the week hits on Friday. That, of course, is the jobs number for April. And if it is as disappointing as today's data, Steve Blitz, director and senior economist at ITG Investment Research, says it's a sure sign the recovery has stalled. Now, Steve has been covering and analyzing the economy for more than 3 decades. He has been a guest on our show, and we are happy to have him back. Welcome, Steve. Always great to have you.
Absolutely. Thank you for having me.
So you're on the more bearish end of consensus forecasts for a lot of the data, particularly released this week. But let's just focus for a second on the Case-Shiller data. Was that a surprise to you?
Not to us, not to our models, because we were looking actually for minus 3.6% year over year, and it came in down at minus 3.5%. So no, to us it was not a surprise. And what we see actually for the next few months is that the year over year decline will actually abate a little bit. So think of it like minus 2.5%, minus 1.5%, minus 0.5% for June, based on the preliminary data that we get at the firm.
Steve, what are you focused on most this week? And we talked about a lot of data. We have it pretty much across the board, right? We've got some vehicle sales, we've got chain store sales, and of course on Friday we have employment data, and we talked a little bit about some of the housing data. We've got mortgage applications out tomorrow morning. So which of these are you most focused on? Quite often we focus most on employment, but...
Well, I think employment is the most important, and it's the most important because policy keys off of employment. Any question of QE3 existing or turning over is really going to depend on the jobs numbers. And we're looking for the jobs numbers to slow. We're looking for maybe 170,000 on total, maybe 190,000 for private sector employment. And what we're really looking at or looking for is for the employment number to begin to show the slowdown in the industrial side of the economy that we've seen in the last couple months.
Now, Steve, even though you're a little bit more bearish relative to a lot of the other economists out there, you still don't think we're going to enter a double-dip recession. At the same time, we took a look at sort of end of May numbers from 2010 versus 2011. I know you think we're much better off right now than we were a year ago. And really, when you look at some of the basic numbers, when you look at the Dow, the S&P, when you look at Case-Shiller, when you look at the price of gas, what it suggests is that, you know, stocks are doing well, so businesses seem to be on the right path. But as it relates to just the consumer, things are not looking so rosy. So at what point do you say maybe we could enter another recession?
The economy doesn't fall into recessions just sort of out of momentum, out of lack of growth. And generally speaking, you get recessions when there's some sort of imbalance in the economy that needs to get corrected. We're not there yet. What we really have is really a lack of the impetus to grow that you need. Construction at this point is usually kicking in, and it's not. What we're seeing is a rebalancing of the U.S. economy towards the real goods sector, and that's a very slow growth relative to finance and real estate because it doesn't grow with the same leverage. And unfortunately, because of a lot of external factors, the real goods sector has slowed the last couple months, and now we're going to start to see a little bit of employment. But a double dip, no. Very slow growth, yes. I mean, every time the sun comes up and everyone turns on the lights, this economy grows about 2%. So I think that's a fair assessment.
All right, Steve, do appreciate you coming by. An interesting look. Seems like we could be bumping along here at this slow pace for quite a while. That was Steve Blitz, senior economist at ITG Investment Research.